What's going on, everybody? Liam O'Reilly, Vermont Economic Realtor. Hope you're doing well. The Federal Reserve decided to increase the Fed funds rate today by 25 basis points to a level of 4.75 to 4.5. What does that mean for the overall economy? What does that mean for the real estate market, for inflation rates? What does that mean for you as a home buyer or home seller? So I'm going to get right into what happened today, what Jerome Powell's sentiment was, and how this affects the housing market as well as the overall economy. So Jerome Powell's sentiment was much different than it was in the past meetings. The previous meetings, he was very hawkish. He was certain that more rate hikes were coming, that more tightening was needed because inflation was running rampant. Now, with the collapse of Silicon Valley Bank and Signature Bank, he's less certain about the tightening that needs to be done, and or not the tightening that needs to be done, but how much tightening needs to happen in the future, and if they're going to hike again in May. They say maybe they'll hike, maybe they won't hike. He was pretty adamant that nobody was projecting any rate cuts. Nobody in the Federal Reserve was projecting any rate cuts by the end of the year because of how hot inflation is. Of course, the market is baking that in, that the Federal Reserve will be forced to cut rates because of the impact that these rate hikes have on the economy. We'll see what happens. So, why does Jerome Powell feel less certain that he's going to hike rates moving into the future? Part of that reason is because with the collapse of Silicon Valley Bank and Signature Bank, as well as the issues with Credit Suisse and the overall banking issues that are occurring in the economy right now, Jerome Powell and the FOMC thinks that not necessarily interbank lending, but the banks are going to tighten their lending standards, right? So banks, when they have a place to put their money, banks need a place to put their money, and a lot of times they'll lend that out to people in the form of credit card loans, auto loans, residential real estate, commercial real estate. They'll lend it to businesses to conduct whatever they need to do, and because of the recent bank collapses, Jerome Powell thinks that they're going to tighten up those standards and lend less money to businesses, to individuals, to purchase their assets or spend money on their credit cards, whatever they need that money for, which is going to shrink the money in the system, restrict spending, and hopefully decrease the inflation rate, cause some disinflation. Now, it's essentially the same thing as raising a rate if banks were to do this, because when the Federal Reserve starts to raise rates, the banks now have a place to put their money where they can get a risk-free return. With the Fed funds rate, they can keep their reserves in the reverse repo facility, earn 5% of their money with the current rate that it's at without any risk, right? There's no risk of the Federal Reserve defaulting, compared to if they lend to you or me or a business for whatever reason. There's risk that that person won't repay the loan. And because of that risk, they can charge a higher interest rate. So when the Federal Reserve increases the Fed funds rate, that ripples throughout the economy and throughout the interest rates, and causes higher interest rates, really in all aspects of lending. And those higher interest rates make it more difficult for people to have access to capital, make it more expensive for the borrower to borrow that money, and shrinks the lending that takes place in the system. So with if these banks are shrinking lending on their own and tightening standards of lending on their own, then that is in turn going to do the exact same thing as raising a rate. Now, as raising the Fed funds rate into the future, which is why they are less certain and less confident that they're going to do it. They're going to see if these banks tighten, how much they tighten, and what effects that has on the economy before they decide their next move come May. Now, I don't think this is going to affect residential mortgages. I don't think residential mortgages are going to shoot way up because of this. And the reason is, a lot of these banks don't hold residential mortgages on their balance sheets directly. I mean, they might have mortgage-backed securities, and they originate the loans, but then they make sure they adhere to Fannie Mae and Freddie Mac's guidelines, and then they give them to Fannie Mae and Freddie Mac, and who sell them on the secondary market in the form of mortgage-backed securities, right? So, these banks might own the mortgage-backed securities, but they don't necessarily own the actual note that they're giving you when you get your mortgage as a resident, when you get your residential mortgage. Now, because of that, I don't think those regulations are going to tighten, and I don't think we're going to see less lending or stricter requirements on the residential mortgage space, because a lot of those requirements were put in place, and those restrictions, those regulations were added after the '08 financial crisis to ensure that the people getting their getting residential mortgages, we're in a good place financially. So because of that, I don't think we're going to see the mortgage rates shoot up. They could even come down a little bit. We'll see. We'll see what happens over the next few months. Nobody knows the future. But I don't anticipate them rising drastically. Now, I'm just looking over at my sheet here to see what other things I wanted to talk about. So actually, you know what I'm going to move on to right now is here the impact of these Fed funds rates is the Federal Reserve is at a really interesting place. And let's just get right into this article off of Shift Gold. So the Federal Reserve has been losing money for a while now, and they're losing money fast. Right? So here we go. The Fed booked a $126 billion loss in February. The net income for 2022 was $58.4 billion. And then here we go. To put February's net loss into perspective, the largest yearly gain over the last 10 years was $104 billion in net income. So essentially the Federal Reserve lost more money in February than they have gained on a year-over-year basis in the past 10 years. So what is going on with that? And what does that mean for the economy? In my opinion, I think that's inflationary, right? Because if they're losing money, you know, that money has to come from somewhere. So, all right, let's back up. Why are they losing money? They're losing money because they own these mortgages and they own these treasuries at a low interest rate, right? When they did quantitative easing, they started to buy these U.S. treasuries and buy the mortgages at a cheap interest rate, right? If you know anybody who got interest rate around 3% or maybe even under 3%, part of the reason they were able to get that rate is because the Federal Reserve was a big buyer of those assets, of that mortgage-backed security. And now, as they've hiked up rates, not only has the value of those assets fallen, right? The value of U.S. treasuries, the value of mortgage-backed securities, those have all fallen, but now the return that they have to pay on their Fed funds rate, that 4.75 to 5% return that they're guaranteeing to commercial banks who keep money at the Federal Reserve, they are I mean, how are they going to pay them if the return they're getting off of their assets is from a 2.75% mortgage, or a 0.5% U.S. Treasury, or whatever notes they have? So the income that they're bringing in is substantially less than the income that they're paying out to people who hold their money at the Federal Reserve and take advantage of the Fed funds rate that is so much higher. Now, something else that they're doing is they're running off their balance sheet, right? We've talked about how this can affect mortgage-backed securities, how this can affect the housing market. They're selling mortgage-backed securities for the first time in history. So they're selling the securities at a loss, first of all. But second of all, they're not reinvesting their money into assets that will pay them a higher interest rate, because they're trying to shrink the size of their balance sheet, and they're trying to do quantitative tightening essentially by reducing the size of their balance sheet. But as a result, they're also reducing the amount of money that they're taking in every month, because the sheer volume of assets that they own is decreasing. So the sheer return that they can gain on those assets is also decreasing. Now, the Federal Reserve's balance sheet has ticked up slightly as a result of the bank collapses, but from what I understand and what Jerome Powell said, it sounds like they're not making a great return on that. They just kind of have that extra powder to deploy into banks that need extra liquidity and to essentially bail out these banks. But when the Federal Reserve takes a loss on a year-over-year basis, they are losing. They're essentially, in my opinion, causing inflation, right? Because they're taking money that doesn't exist. If they're losing they lost $100 billion last month. How are they going to continue to do that, right? If you are a regular business, imagine you're a regular business and you are losing $100, or how about this, $100,000 every month. You start with $1 million. Your goal is to make money, but you lose $100,000 every month. After 10 months, you're completely out of money, but you want to stay in business. So you keep staying in business, and so you're still losing $100,000 every month. Where are you getting that money to spend that $100,000 that you're losing every month. Essentially, that's the Federal Reserve. And so I don't see anywhere else that they could be getting their money besides printing it and giving it to these commercial banks, which I don't understand how that isn't inflationary. So, the Federal Reserve is hiking rates and really trying to get inflation down, but at the same time, they're running their operation at a loss, which is adding more dollars into the system. So, I think because of that, it's a broken way to operate, and it's a way that's got to end eventually, and that money will have to eventually be paid back by somebody, and I think it's going to be U.S. taxpayers, or it's going to come in the form of the printing press, where they just added a bunch of money to the system, kind of without even knowing they're doing that because they're losing a bunch of money. I mean, I'm sure they know what's going on, but I don't know. That's what I think is happening. Is I think it could legitimately cause more inflation and make things worse, which could be a part of the reason why people are banking in these rate cuts towards the end of the year, on top of systemic failures that could happen throughout the banking system, throughout businesses, high unemployment. If things really start to fail, as we're starting to see the cracks in the system already, if things continue to get worse, we might see cuts coming into the future. So anyway, all my contact information is in the description. If you're looking to buy or sell a home here in Vermont, feel free to reach out. Let me know what you guys think as well. I love learning from you folks. I love hearing your perspective on everything. Do you think I got this spot on? What do you think about the Fed losing money on a month-over-month basis? What do you think about the rate hikes? What do you think about the Fed speech? I'll leave the link to the Peter Schiff article and then also the Federal Reserve speech in the description for you folks. Other than that, enjoy the rest of your day.